Hello, and welcome to the Certified Equity Professional Exam Overview webinar for Level 3. My name is Pam Chernoff. I'm the Curriculum Coordinator here at the CEP Institute. This segment of the webinar is focusing on corporate and securities law. The webinar is provided to assist you in your exam preparation process. This Level 3 webinar is being conducted by Jennifer Cascio, who's Senior Stock Administrator at Flex. She's also a CEP and a member of our curriculum committee at the CEP Institute. So 26% of your test is on corporate and securities law questions. It should be 17 or 18 questions. You may see one or two more than that just because 7 of the questions on the exam are experimental items that we don't use towards scoring the exams. On Level 3, this is true at all levels. You'll be responsible for the topics that were covered in Level 1 and 2, and you should definitely refresh on those topics, including you can listen to the webinars on the Level 1 and 2 topics in any of the domains. This webinar will go over some of the things that come into play initially at Level 3. We're not going to go back and cover the things so much that were on earlier levels, but that you might expect to see more difficult questions on this test. And on that note, I will hand it over to you, Jennifer.
Thank you, Pam. First, let's talk about an exemption from the regulation that comes into play in Level 3. I don't know if you're familiar with this, but Regulation D is an exemption that can cover the private offering and small, limited sales of securities. There are 2 exemptions, both of which require filing a relatively simple form with the SEC. The first exemption under Reg D is Rule 5, which exempts an offering of up to $5 million of stock in any 12-month period. The section, Rule 506, allows the sale of an unlimited amount of securities to accredited investors, and also sales of up to 35 non-accredited investors. Now, let's take a look at some of the new details under the Securities Exchange Act of 1934. At other levels, we've covered various disclosures and matching requirements under the Act, but on L3, are a few others that come into play. Public companies are required to report certain events related to their executives within the 4 business days on the Form 8K. Some of these disclosures apply only to the named executive officers, otherwise known as NEOs, named in the proxy statement. Others apply to a broader group of executives. So here is what must be reported: the retirement, resignation, or termination of a specified officer, meaning the principal executive officer, president, principal financial officer, principal accounting officer, principal operating officer, or any other compensatory arrangements with the new directors or specified officers, along with a brief description of the compensation. Any material amendment to the compensation arrangement with an NEO, including a brief description. For this one, broad-based plans such as Section 423 ESPP do not have to be reported. Any salary or bonus amounts that have been previously omitted from the summary compensation table because they were not calculable. If a plan that includes executive officers is modified, but the results of the modification isn't material to a specific executive officer, the modification doesn't have to be disclosed on the Form 8K. Section 12 of the Exchange Act requires companies to register a class of shares with the SEC if the share class description on this slide. Companies that are subject to Section 12 are also subject to various reporting and disclosure requirements that we'll cover in the next few slides. The 34 Act has additional disclosure requirement under Reg 13D and 13G. Under these rules, anyone who owns more than 5% of any registered class of a public company's shares are subject to reporting and disclosure requirements. To make these disclosures, they must file a Schedule 13G or 13D or 13G. Schedule 13 It requires information about the source and the amount of money used to acquire the securities, the purpose for which acquired, and whether there are any agreements between the filer and the issuing company relating to the shares owned. Form 13D must be filed with the SEC and sent to the issuer within 10 days of acquisition that triggers the filing. After that, the filing must be amended for any change in beneficial ownership of more than 1%. Schedule 13G is available to a limited category of investors who don't intend to influence control over the investor and who own 20% or less of the issuer's common stock. 13G must be filed within 45 days of the end of the calendar year in which a 13D would have been required. Proxy disclosures. On previous levels, we covered proxy disclosures for most public companies, but at level 3, we add information about two different categories of companies called emerging growth companies and smaller reporting companies. These are companies that are required to register their securities under the Exchange Section 12, which we will discussed a few moments ago, but that are exempt from some disclosure requirements because of their size. Emerging growth companies are private companies and newly public companies with total annual gross revenues of less than $1 billion. These companies do have to follow the registration requirements of Section 12G of the Securities Act of 1933, have as many disclosure requirements as other public companies do. Smaller reporting companies means generally those with less than 250 million of publicly traded stock or companies with less than 100 million in annual revenues that have less than 700 million in publicly traded stock. Both of these groups are subject to fewer reporting requirements than larger public companies. They are required to have summary compensation tables, but those tables cover the compensation of only 3 named executive officers instead of the 3 required for other public companies, and disclose 2 fiscal years of compensation instead of the usual 3. The NEOs for these companies are the CEO and the next 2 highest compensated employees. Emerging growth companies are exempt from some of these disclosure requirements, but they are required to file outstanding equity at fiscal year-end tables and a director compensation tables. They need not file with other disclosures. Instead of filing a CD&A, they can provide a narrative description of information necessary to understand the summary compensation table. Now let's talk about repricing of stock options. When a company's stock price drops and outstanding options granted are deep underwater, meaning the exercise price is much higher than the current share price, companies sometimes want to reset the price so that the options are once again valuable to employees. To do this, the company can make an offer to employees to cancel the old options and replace them with new ones, or with a different kind of equity grant, but only if careful consideration and if the plan allows. Repricings carry a variety of implications. First, if the plan document does not allow for a repricing, then publicly traded companies must seek shareholder approval under the exchange listing requirements. Second, there are both Section 16 and proxy disclosure requirements for insiders who participate. A repricing is reportable on a Form 4 and must be disclosed in the Summary Compensation Table Narratives section. Shareholders may object to repricings, and companies must weigh whether the potential for negative reaction and even lawsuits by shareholders, particularly institutional shareholders, is worth the trade-off. Replacement grants will often be less generous than the original grant, in part to assuage shareholder concerns and sometimes because the company is trying to avoid additional accounting expense. Once the company decided to go ahead with a repricing, it can't just outright replace the old option. Instead, it must offer the exchange to employees and allow them to decline to participate under the tender offer rules. Employees must be giving at least 20 business days to refuse the offer to cancel the old grant with a new grant. Normally, the tender offer rules require that the same rights be offered to all shareholders. However, offers made for compensatory purposes are exempt from the rules' non-discrimination requirements if the requirements listed on the slides are met. What is a must in this exemptions from full tender offer rules about offering to all classes if meet these requirements.
All right, thank you so much, Jennifer. So for candidates who are interested in additional courses that may help with your exam preparation, we've listed a couple of options on this slide. We've provided this webinar to assist you in your exam preparation, but the webinar in and of itself is not sufficient exam preparation. I just want to remind you that all of the test questions are developed exclusively from the assigned reading materials, and you should definitely study those thoroughly. This webinar is available to you for unlimited viewing until the exam date, and the same is true of webinars for the other exam levels. So again, if you want to brush up on some of the law content or any other content that was introduced at earlier exam levels, I would encourage you to go back and listen to those again. So thank you so much, Jennifer, and good luck on the test, everybody.